Hey, welcome to another small part of the chapter. This is inside wealth versus outside wealth. Page 93. It is often used to distinguish between types of sectors in the economy. The most basic distinction is between the public sector, including all levels of government, and the domestic private sector, households and firms. Note that we are simplifying by excluding the foreign sector as if the economy were completely closed to trade and capital flows. If we were to take all of the privately issued financial assets and liabilities, it is a matter of logic that the sum of the financial assets must equal the sum of financial liabilities. In other words, net financial wealth would have to be zero if we consider only private sector IOUs. This is sometimes called inside wealth because it is inside the private sector. In order for the private sector as a whole to accumulate net financial wealth, the inflow must be in the form of outside wealth, that is, financial claims on another sector. Given our basic division between the public sector and the domestic private sector, the outside financial wealth takes the form of government IOUs. The private sector holds the government currency, including coins and paper currency, as well as the full range of government bonds, short-term bills, longer maturity bonds as net financial assets, which is a portion of its positive net wealth. Net private financial wealth equals public debt in our closed economy without a foreign sector. Recall from our discussion above that the accumulation of stocks requires flows. The private sector's accumulation of net financial assets over the course of a year is made possible only because its spending is less than its increased income over the same period. In other words, it has been saving, which enables it to accumulate a stock of wealth in the financial assets or on government liabilities. Government currency and government bonds. These government IOUs in turn can be accumulated only when the government spends more than it receives in the form of tax revenue. This is called the fiscal deficit, which is the flow of government spending less the flow of government tax revenue measured in the money of account over a given period, usually a year. This deficit accumulates to a stock of government debt which will be equal to the private sector's accumulation of financial wealth over the same period. A complete explanation of the process of government spending and taxation will be provided in Chapter 20. What is necessary to understand at this point is that in our two-sector example, the net financial assets held by the private sector are exactly equal to the net financial liabilities issued by the government. If the government's spending always equals its tax revenue, the private sector's net financial wealth would be zero. Rest of world debts are domestic financial assets. I hope I didn't say assets, but anyway, we can broaden our analysis by considering the financial assets and liabilities of the rest of the world. Thus, we now form three sectors in this open economy: a domestic private sector, a domestic public sector, and a rest of the world sector that consists of foreign governments, firms, and households. In this case, it is possible for the domestic private sector to accumulate net financial claims on the rest of the world. Even if the domestic public sector's spending over the period exactly equals its tax revenue. The domestic sector's accumulation of net financial assets is equal to the rest of the world's issue of net financial liabilities. Finally, and more realistically, the domestic private sector can accumulate a net accumulate net financial wealth consisting of both domestic government liabilities and rest of the world liabilities. It is also possible for the domestic private sector to accumulate government debt, adding to its net financial wealth, while also issuing debt to the rest of the world, reducing its net financial wealth. Non-financial wealth, real assets. One's financial asset is necessarily offset by another's financial liabilities. However, real assets represent one's wealth that is not offset by another's liabilities, so at the aggregate level, net wealth equals the value of real non-financial assets. To be clear, you might have purchased an automobile by going into debt. Your financial liability, your car loan, is offset by the financial asset held by the auto loan company. Since that asset and liability net it to zero, what remains is the value of the real asset, the car. In most of the discussion that follows, we will be considered with financial assets and liabilities, but we will keep in the back of our minds that the value of real assets provides net wealth at both the individual level and at the aggregate level. Once we subtract all financial liabilities from the total assets, real and financial, we are left with a non-financial real assets or aggregate net worth. And the next one, 6.4, aggregating NEPA, stocks, flows, and the flows of funds account. Next time on the show. Thanks for watching, and please subscribe, comment, like, share, and #LearnMMT.